One, two, one. Hello, hello, and welcome. Thank you, everybody, for coming live today here at the headquarters of Multifamily Empire. Thank you so much for coming in. So, if you guys want to go ahead and take a seat, and we're probably going to be starting here pretty soon. And let me see, we got some folks joining online as well. Let me see here. We got a bunch of people here. So, if you're online, I want to suggest that you play full out. So make sure your camera is on so we can put a face to the name. That's always great to see who's there, who's joining us, who want to learn from the one of the key players on this market right now. So make sure you're playing full out. Make sure you take notes. Make sure you write questions. This is what's gonna maximize your experience here. At the Market Pulse Masterclass. So make sure you're taking notes because whenever we open for a Q&A, it's going to be super cool to hear your questions so you can have your questions answered by all these amazing people that are going to be here today as panelists. And let me see. Right now, I see Gracinda online. Gracinda, thank you for coming. Appreciate you. I see Francis in there too. If I'm not seeing your face, I can't really see if you're happy here or not. So make sure you turn on your camera. Let's see, I see Lola over there as well. Lola, thank you for joining as well. Thank you for turning on your camera. And in a couple minutes here, we're gonna get going. We're just waiting for a couple more people to join us on the Zoom meeting. Let me see here. Trying to see who else is turning on their camera right now. I'm gonna be calling people out. Ralph, I do see you, man. Thank you for turning on your camera as well. I appreciate you. Oh, that's Sandro. Ralph is right next to you. Sandro, thanks for joining, man. Appreciate you. Ralph, you're all the way in Florida, and I heard that Florida people don't like turning on their cameras. Let's change that tonight. We're going to change that tonight. We're going to show them that you guys are not camera shy, so make sure you're turning on your camera as well. And for all of you that are here and for other people that are online as well, we do this event every other month, but every month we do an event kind of like this. These events are for y'all. These events are to promote the best people in the industry. This is an event that's going to show you what's going on in the market. This is an event that's going to share their experience, their current experience. So if you have any questions, if there's any doubts in your mind, they're going to make sure you leave this event with no doubts, at least most of it, you know? But that's what we're gonna try. That's what we aim for. So we do have Jazz and Apartments coming up next month. So if you love this kind of event, make sure you follow us on social media. That's where you're gonna get majority of the information about all the upcoming events that us at Multifamily Empire are hosting. If you like to hear stories like motivational stories, great coffee, we do have the Real Grind podcast that is live every Tuesday. So make sure you follow us in there as well. It's a little more casual. It's a little more relaxed per se. And I get to play the bartender or the coffee master or the barista, whatever you want to call me. But sometimes they do pull some pranks on me. So I got to put up with that. But I do make him some good coffee, trying to balance it out. But once again, thank you all so much for coming. With no further ado, I want to introduce on stage Neander and Delia Lima.
Let's go.
Let's go.
How many of you have watched the Real Grind podcast with the coffee master here? Man, it's been a blast, you know. It was two of the passions, you know. We started this real estate experience, and then we have the coffee experience. We do have a small coffee farm in Brazil, if you don't know. So we are so passionate about coffee because we don't drink coffee like most of the people. We have to have it. We have to weigh the beans, the right temperature, and all that stuff. But, you know, we just come from Mother's Day. And how many moms out here today? Or moms? There you go, some moms. And online for some moms. So I've been picking up my daughters every day on the after school. I've been picking them at school every day. So it was Mother's Day, and Ariana, our oldest daughter, she's 4. She made this beautiful card for Delia. And what was interesting about it is that when I picked them up, we'd sing a few songs. You know, if you actually can quiz me on every Disney song, what every princess says, I'll be able to tell it all. Like, I know every single one of them. But this card was so nice because the teacher, obviously she doesn't know how to read and write, but the teacher asks her questions. It's like, what's your name? Your mom, Delia. And name her color is black, eyes brown. And then they're asking, what does she like to eat? What's her favorite food? And Ariana says, leftovers. That is her favorite food. And then she likes coffee and water. And then it's like, what is your favorite restaurant? You know, Ariana said, Costco. That was super fun and genuine. But, you know, like, it's very genuine. And like, we tried our best to teach our kids something that my parents didn't teach me. They taught me how to be a good man, very responsive, work hard, but they didn't teach me anything about how to manage money and work with finances, right? I have to learn all that as I was an adult, which, you know, nowadays I try to teach my kids in the very young ages, like, you know, what is to be economical, is to invest, you know, and to be, this world is kind of crazy right now, right? So without further ado, I'd like to bring the Costco restaurant eater and the leftovers here on the stage, my wife and business partner, Delia Kong. What's your favorite restaurant?
I was like, what can I say? I'm a cheap date, right? Leftovers from Costco. So we do cook a lot at home, but I shared that image with my mom, and I'm really proud to say that, you know, that's how we grew up. And, you know, I really enjoy quality, beautiful things, but I also like to be economical. And that's how we run our businesses. That's our philosophy, and also how we run our properties. So if you want someone who watches the bottom line, this is it.
Delia doesn't let it fly anything, man, anything in the property. So share a little bit on this awesome slide here. Let's go ahead and have it on the screens too, Holden, over here.
Well, we also want to share a little bit of content, because this podcast or this show is also about building wealth for, you know, your family, generational wealth. So Warren Buffett, a very wise and wealthy man, once said, you should never buy an asset in which the only way you get the value of it is if you sell it. So I'm going to repeat that one more time. You should never buy an asset in which the only way you get value of it is if you sell it. So for instance, let's say you have cash, and you can either buy a brick of gold or a 2-bedroom home. Next slide.
Next slide.
Okay, so brick of gold or a 2-bedroom home. And let's say you hold it for 100 years. So with the brick of gold, you can put it in a safe, you know, in your closet. And let's say every Sunday you invite your friends over for dinner. Afterward, you can open that closet and say, hey, look at my shiny gold. And if you hold it for 100 years, yes, it does appreciate in value. But during that time, it doesn't spawn you new gold to enjoy. Okay? And the only time you realize its value is when you sell it. And when you sell it, you don't have any more gold. In contrast, if you bought a 2-family or a 2-bedroom home, and let's say you rented it out, like gold, it does appreciate in value. The land appreciates, the home appreciates, and if you hold it for 100 years, during that time, you're able to extract value from it in terms of passive rental income. So you're able to enjoy the fruits of your labor, and you can still hold on to it. So at the end of 100 years, you still have that home. You can still
And you can get
value.
the cash flow, you know, if you rent it out to tenants, you get the cash flow to the whole period of time of that asset, and then they all both grow in value. So, you know, just that's the difference. So it's very powerful.
Yeah, it's very powerful because it really shows how you can let your money work hard for you instead of you working hard for your money. And that's what today's show is about. We bring the experts and to bring value to everyone here.
And today we would like, you know, we try to surround ourselves with, you know, a good team. This especially, we're in the multifamily, but we do encourage and we cover a lot of other assets, people that does single family and any kind of type of real estate investing. And we try to surround ourselves with, you know, peers, people that leverage other people's experience. And then we put this panel together. We have a lot of questions about what is the market, what kind of loans are you getting right now, what's you know, as far as insurance and all that stuff. So I'd like to invite at this time our panelists to the stage so we can all ask them questions and talk a little bit about what's in the market. Welcome. What's up, beautiful people? Well, first of all, thank you so much for coming in and here today, to talk to this. We got some people online there. We have some people here in our headquarters. And let's start here with you, Andrew. If you introduce yourself a little bit and tell what you do, man.
Sure. My name is Andrew Russell. I'm a senior vice president with Bellwether Enterprise, and I focus in multifamily loan originations, specifically with Fannie Mae and Freddie Mac.
My name's Rock Stevens with Strategic Insurance, and I'm the lead agent, co-owner in the insurance company that provides instant quotes and does a lot of the insurance actually for most of the people in the room and a lot of people throughout Texas.
Sweet.
I'm Ford Brawley, and I work at Marks & Millichap, do workforce housing, BNC housing throughout DFW, and partners with Al Silva and Dylan York, and we got Brenna Lindsay on our team as well. And we're excited to be here. Thank you for having us.
Yeah, man, that's awesome. So I want to start just cover a few topics. Dali, you said about right now is the time because people buy, let's say, real estate 10 years ago, they could just fall asleep and walk out 3 years later and make a bunch of cash, right?
You still have to operate it.
Yeah, you still have to operate it, but And now with you and everybody, we just try to be a little bit more conservative, right? And so what is things you're seeing now as far as to be economical, to tie the operations and be hands-on? So would you like to share, please?
Yeah, so like Neander was saying, about 10 years ago, people really did buy assets, hired property management companies, didn't have to keep a really close eye on it, and the deals would still perform. But today that story isn't true anymore. You really need to keep a closer eye, both in terms of pushing rents, but also on tightening your expense line. So, each month we go line by line, and if we see any anomalies, we try to really catch those to see if, for instance, did we get an extra invoice? Was that billed correctly? And also, like say for instance, one of our properties is an all bills paid property, and so we thought, what can we do to reduce the income line, reduce the expense line? So we started looking at solar, because if we are able to save about $50K in energy expenses by capitalizing a solar cost, that would also increase our NOI. So that's just one example of how creatively looking at things. It wasn't in our original underwriting, but now is the time to really think outside the box and what other ways could I bring value that I didn't have in my original underwriting.
Yeah. Mention that example that, there's some NOI things that people are doing now to push the needle. Some extra incomes on the property, like that ring doorbell, something we implemented. So can you bring a few examples?
Yeah, so ring doorbell is one. So obviously, folks might have a ring doorbell, but for working class communities, they aren't allowed to install certain types of devices. So by renting those items back, they don't have to put the upfront cost or maintenance if someone rips the doorbell, et cetera. And also, it's great for resident security, so they know that there's probably a decrease in, say, package theft and different people walking around the property. So it really kind of brings that sense of community up, where there's like a community watch.
Cool. Ford, what have you seen on the market for the first quarter, man? As far as deal flows, I had a conversation with Al a little bit, but what have you guys seen as far as the markets and going on the first quarter of deal flows?
Yeah, I mean, it's no secret transaction volume is down. The interest rate shock has changed, how the volume that we're seeing. But I think I was reading something the other day, DFW, apartment sales down about 80%
Wow.
year over year. And obviously last year was the highest year ever. And, this year's, it's not the lowest year ever by a stretch either. So it's getting back to kind of a normal sense, right? But, as of right now, transaction volume is still down. Our team's had, our transaction volume's down about 55% so far this year. So we're actually, excited about that. And we've got more things coming out. And as far as, activity that we're seeing, I mean, early 2022 or late 2021, we could put a deal out in the market and we'd have, 35 tours. There are some days you don't even have to pick up the phone. You get 30 phone calls in right about the deal, and that's altered, but we're still seeing, 15 to 17 tours, so it's about half. And instead of getting 10 or 12 offers, we're getting 5, 6, 7, 8. We're still hitting pricing guidance, but cap rates have moved a good bit as well with that. But I think the bid-ask gap is from, middle of last year, bid-ask gap changed drastically, and there just wasn't really a whole lot of trades going on. But I think this year it's come back around.
True.
People have gotten more settled into what's happening, and we've seen more transactions from that.
Yeah, and so I know you guys obviously I've seen a lot of foreign and Bradley deals coming in through our doors, man. It's like, so what was the most common questions you see now from buyers?
Yeah, how old are the roofs? What's my insurance number going to be? What's the delinquency? Yeah, is anybody paying rent? And but it makes sense, right? Because we think about, and Andrew will get into this more, but how debt has changed, and
Sure.
you know,
Which is a huge factor in our industry.
huge factor, right? And so this time, or maybe not this time last year, but early 22, you're buying a deal with bridge debt, and you're like, I'm gonna change it. I've got this business plan. I'm gonna implement all this capex, and because they will fund part of your capex. But this year we're doing mostly agency stuff,
Yeah.
and so those loans don't include capex, and people aren't, credit's tight, raising equities tight, right? And so people aren't looking to raise all these additional funds, and so you're like, well, I'd love to buy this deal, but I don't want to pay $400,000 to change the roof,
Yeah.
right, and stuff like that. So it goes hand in hand with the financing changes as well. I think that's the big thing.
Sure. And what do you see? Would you like to cover something? No. What are you seeing as far as like for deal flows for the third quarter, for the second quarter, and rest of the year? You think we start opening up the gates again since we're kind of figuring out our loan structure?
Yeah, I definitely agree with that. I think we've already seen it. We track every deal that comes on the market weekly. We have like a report that comes to us from our team, and you can see every week is like the first month of the year there was like 0 deals, and then it was like 2 deals a week, and now 3 or 4. So it's building, and I think that goes back to people understanding where the market is, understanding where cap rates have moved to, and interest rates have stayed settled for about, I don't know, 45 days or something now. So I think all those things are really important. And then, the back half of this year, I think we're going to see more people who are like, okay, I've got a year or 2 here before I have to make a decision, but I've got my NOI up. I feel comfortable with this. I executed my business plan. Who are going to be comfortable selling again now that they understand where the market is, as opposed to going out there semi-blind or without as many comps. So I think that'll pick up, and then of course there's the certain part of the market that's going to have rate caps and bridge notes coming due. That's going to hit as well, and some of those will hit well, and some of those are going to hit in a little bit of trouble, and there's going to be distress there as well. So there's going to be a little bit of everything, I think, for the back half of this year.
Yeah, that's a good point. And so I have a question for you. Now we're talking about buyers. So let's say that we have a deal, because people, I hear this on the streets right now. It's like, hey, if you have a good cash flowing deal, do not sell it. Don't. But what would be your opinion of right now? You hit all your projections, your deal, it is cash flowing, but F2 is sell.
I hope they sell, but it just depends on what you want to do, where you are, and kind of your company's business plan, right? Apart from the apartment business plan, like what's your next chapter, right? Like, hey, did you buy this thing for whatever, 65 a door, and now it's worth 100 a door, and it could have been worth 115 a door last year, but you still did really well, and now you can go buy something else at 75 a door and start over. That's a really good opportunity, regardless of market conditions, and frankly, the market conditions are helping you on the buy, right? So it'll just depend what people kind of end up wanting to do, but there's a lot of cash flowing deals on the market right now. I know that, so you can always replace the cash flow, and I think you can replace with other opportunities.
Mm-hmm. Okay, do you want to add anything?
You want to ask about loan terms?
So, all right, so let's switch to that goes hand in hand with Mr. Broker there. And so what you have to say, what you see now on an interest rates, was just a big deal, right? We just have rapidly for the past 12 months / year just a skyrocketing. So a little bit of down the right in there.
Sure. Yeah. So I'm a very hands-on loan originator. So the first thing I do every morning is I check the 10-year U.S. Treasury, and I check CME term SOFR. And that's a stressful start to every day, but it's something that we've been navigating. And I'll speak about rates in the context of starting from COVID to now. During COVID, we had interest rates at 0% in both the floating rate index market and the U.S. Treasury market. And since then, we've seen SOFR, CME term SOFR, which ties very closely to the U.S. Treasury benchmark rate, has gone up 500 basis points over the last 24 to 36 months. So some would say unprecedented increase in rates, which has been very interesting to navigate. But the rate conversation is really bifurcated between two conversations: the floating rate market and the fixed rate market. So currently, floating rates are, with a bridge product, for example, a value-add bridge product where you want to have a lender fund your CapEx. Those rates are floating around 8% currently. But agency fixed rates are actually, depending on the amount of affordability and mission-driven business, which we can talk about in a little bit, you have at your property, fixed interest rates, even on short-term deals, like 5-year fixed rate deals, are in the low 5% range, which represents almost a 300 basis point delta between a floating rate bridge and a fixed rate perm deal. So we recently had a Fed meeting where the Federal Reserve decided that they wanted to, they didn't state this exactly, but they didn't add any additional language that they're going to continue interest rate hikes, which was very positive news for the market. We actually saw the forward curve, the projection for SOFR by the end of this year and going into next year should drop by 150 basis points. So there's a lot of positivity going on. It feels like we have weathered a very difficult storm over the last 18 months, but from what we can tell, and coming from someone who personally checks rates on a constant basis every day, I check it more than I check what time it is. It feels like things are moving in the right direction. And just to give you some context about a basic rate today, call it a 10-year, your spread for a workforce housing deal would be in the 170 to 180 range, and the 10-year Treasury, I believe, closed today at 360, so that puts you at about 5.3. To give you some context about how an agency rate is built up, there's, with Fannie Mae specifically, that will help explain this. There's two portions of the rate. There's the credit fees, and then there's an MBS investor. So when we go to rate lock a Fannie Mae loan, we go and we trade it with an MBS investor, and those spreads are currently about 80 basis points. So the Fannie Mae and the DUS lender portion is about 100 basis points. That matches very closely with Freddie. We saw during COVID the MBS portion of those rates go as low as, we actually rate locked a deal at -3 basis points.
Wow.
So when you think about that, and in context of where we're at today with interest rates, you've got, call it on average between a 5, 7, and 10-year MBS investor spread, call it 80 basis points. If you know that the range there is going down to 0, it feels like there's some very positive downward movement that we can expect with rates over the next 12 to 24 months, especially with the imminent presidential election cycle. It's going to be a very hot topic within that cycle, and we expect the U.S. government and folks who are working to win the next office to push interest rates downward.
Man,
so that's a lot of information there. I'll pause.
Yeah, that's amazing, dude. Like, the amount of knowledge that you carry, and that's because you seek that knowledge every day, and that's amazing, dude. Thank you for sharing that. And what are you seeing now as far as options for financing, for debt, for deals that come into the market now?
Sure. So I'd say if there's a theme of this year, the theme is fixed rate. As you can imagine, it's very difficult to make deals work at an 8% interest rate. People are seeking positive leverage, which means your going in interest rate is less than your going in capitalization rate. But what we've been advising clients to take on in terms of financing at this point in the cycle is short-term fixed rate financing that gives you flexibility within the next 3 to 5 years to be able to refi or sell at minimal prepayment penalty. Because a mistake that a lot of mortgage brokers and sponsors made back in the 2016 to 2018 stretch of the multifamily industry was they all did 10 and 12 year, not all, I'm sorry, I don't mean to generalize. A lot of people did 10 to 12 year fixed rate mortgages, which carry very long-term yield maintenance penalties. And the way that yield maintenance works is it's the present value of your future payments. So as rates go up, your yield maintenance goes down. As rates go down, key part of the conversation here, your yield maintenance goes up. So the last thing that we want to do right now, when we're of the general opinion that rates are going to be going down, is put someone in a long-term fixed rate deal with an extended yield maintenance period such that when they try and prepay in year 4, with rates going down, it's actually going to look way worse than it would look if rates were even flat. So what we advise clients to do currently is take on 5-year fixed rate deals or 7-year fixed rate deals that give you flexible prepayment. optionality. And at this point in the cycle, it's starting to feel like, I know I was dogging on floating rate financing earlier, it's starting to feel like floating rate financing might be a good route just due to the forward-looking curve. Because your floating rate is high right now because of one thing, the index. The index is 5%. Spreads on, call it a traditional floating rate bridge loan with someone who's going to fund 75% loan to purchase price, 100% capex.
Yeah.
Their spreads over the last 24 months have not deviated too much between the 300 to 400 BIP range. So spreads have actually stayed steady. So if you get a good spread like that, call it 3.25, and you're of the opinion that SOFR could go to 2% in the next 18 months, well, you might be in a good spot. But it's a little bit of a risk and a little bit of a gamble. But it's we feel like we're getting to the peak of where rates will go, and that's always a good time to lock in a low spread when you have a floating rate index, because the floating rate index is what makes your rate high when the index is high, and when the index comes down, your all-in rate comes down. So 5-year fixed, 7-year fixed. We're calling it, Fannie has a product that's a 5-year fixed rate deal with 3 years of yield maintenance. Last 2 years open at 1%. We call that the bridge to a better day, because it gets you 5 years of loan term. You feel comfortable over the next 5 years, and then you have prepay after the end of year 3. Prepay flexibility.
Yeah, that's unheard of, because before Fannie and Freddie, they were always, 7, 10, 12-year terms, and the fact that they're actually responding to the market, I'm guessing they probably lost a lot of business over to the bridge lenders the last 2 years.
Yes, definitely. And, the Fannie and Freddie maintain their standard credit underwriting parameters, so they aren't getting overly aggressive there. But, with loan structures and that kind of thing, they understand what's going on in the market, and they want you to, have the flexibility to capitalize on potentially lower interest rates down the road.
Okay. And something you mentioned about affordability, is this a new program, or can you talk a
Sure,
little bit
yeah.
about that?
So speaking in the context of multifamily finance with workforce housing, that's your C-class properties, B-class properties, and sometimes even A- properties. In Fannie and Freddie's eyes, those properties have a large amount of naturally occurring affordability at 80% AMI. So the rents, if you were to look at it from the standpoint of Allura, the rents would be, all 100% affordable at or below 80% AMI levels. So what Fannie and Freddie are doing is they're allowing you to get benefits for self-imposing rental restrictions on workforce housing properties where there's a lot of naturally occurring affordability at 80% AMI, 60% AMI, and in exchange for that, you get sometimes a stronger consideration for a 35-year amortization, and you also get an interest rate discount, typically about 20 basis points. And what we have found when we're looking at these deals, and mind you, this is deals built between 1960s and 80s, 90s. Once you get to the 2000s, the affordability at 80% AMI starts to come down a little bit in terms of a percent of the overall property. But for these workforce housing deals, we have found that on average, if you layer in these rental restrictions, you can get anywhere from $200 to $300 rent premiums above what the property is currently getting, and still maintain affordability. Because that is, my team's mission, my company Bellwether's mission, and Fannie Mae and Freddie Mac's mission is to preserve naturally occurring affordability in the multifamily space, because there is an affordable housing crisis, and that's our mission. So when we can offer a financing platform that allows us to progress our mission, and you all to continue to progress your mission with your investors and growing rents and renovating the property and preserving the asset, then that's a win-win for everybody, and that's what we're all about.
Okay. Now, is this a new program, and how does it differ from Laura's?
This is a new program. My team back in 2020 actually did the first one of these deals with Fannie Mae. Well, one of the first. I don't want to take credit for that. But one of the first programs under the Sponsor Initiate Affordability Program. So it came out in 2020, and most of the agency deals that we do as a team involve these self-imposed rental restrictions, because our sponsors know that they can still implement their business plan and preserve affordability and get the interest rate benefit, which is helps improve the returns for the investors. To answer your question about how this differs from LURA, the rental restrictions here are tied to the loan documents only. And so if you pay off the loan, say it's a 5-year loan, the rental restrictions go away. That's upside for a new buyer, for you on the sales broker side. And there's no regulatory agency. Bellwether, your loan servicer, or if you work with CBRE or JLL or whoever, they will be your compliance monitoring agent, and they check a rent roll once per year to make sure that the affordability is in compliance, and so long as it is, you're good to go. So
Excellent.
it's better than Allura because you don't have to deal with the headaches of, and headache might not be the best word, the excessive work that's involved with dealing with housing authorities. You can just deal with your loan servicer who you already have a great relationship with.
Yeah.
Awesome. I'm going to pick a loan servicer that checks my sofa every morning, if that's the first thing he does when he wakes up.
It's interesting that, Fannie and those agencies, loans, I remember we bought Enclave, that they have an incentive to do a green, what they call the green loan.
Yeah, the
that we
green loan.
had to change a few of the items on the property, like LED bulbs, more efficient and stuff. So that was one of the incentives, part of the loan, which that was pretty cool. It was the first time that I ever have experienced that. And
Yeah. Yeah, and the green programs with Fannie and Freddie are actually getting a little bit bigger now. So you get an interest rate benefit if you do green conservation efforts. Those typically involve water and energy conservation efforts. I
Yep.
believe, I'd have to go back and double check this or talk to my great team that I have back home who knows all this stuff for me. But I believe it's 15% water savings and 15% energy savings currently.
cool. And just to close this section of lending, what would you, a piece of advice you have to say for somebody now that is looking for that refinance, that expiring, and that needs the new debt, and what was the kind of piece of advice you could say?
Sure. So in the context of a refinance, I would say property condition is paramount. My team at Bellwether, along with our leadership team, just came from the Fannie Mae Dust Conference, and that's something that they are very much pushing is property condition. So make sure that you're taking care of your property. Outside of refis, in terms of overall, a pro tip I would give, put yourself in a position to rate lock as quickly as possible. That doesn't mean that you need to rate lock as quickly as possible, but put yourself in that position in such a way that you can watch rates, whether they go up or down, and be ready to pounce, if you will. We had a client earlier this year, I believe it was in February, called a dip in the we did a 7-year U.S. Treasury, and he was able to lock in his rate at 4.95%, and that's because we, as a lender and him as a sponsor, collectively worked to sprint to be in a position to rate lock as soon as possible. So I would say with rates moving like they are, the 10-year basis point I think has moved on average 10 basis points every day over the last 24 months. You want to be in a position to capture that little dip, because that little dip, depending on the size of your loan, could get you $500,000 or could get you $100,000. So you want to make sure you're taking the time to position yourself to capitalize on a dip in rates.
Amazing. Thanks so much for sharing this knowledge, man. It's great. Like, how many of you just got blown away for this information?
I just got massive value.
It was like awesome. Thank you, Andrew. Sure. And Rock, you became a operator's best friend didn't you, man?
Oh, yeah.
So, as far as insurance, man, talk a little bit about.
I just want so for all the folks doing underwriting out there, obviously you contact your third-party property management company to get you a pro forma for your deal to make sure that your business plan also fits their projection on income and expenses. But the two line items that they do not provide pro forma is the insurance and taxes. So today we've invited Rock over, who is one of our insurance experts for kind of his pro tips on insurance.
Insurance is definitely the hot topic of 2023, unless you've lived under a rock, and no pun intended. It is what makes or break a deal, it seems like, in 2023. It really is. And in fact, a lot of my clients, they'll go through the underwriting on the insurance first. If they're underwriting, let's say, 50 deals or 100 deals a month, they'll check that number first before anything else, because that one expense item really can blow the NOI, and all valuations lead, obviously, from NOI. And so, a lot of these, if we're able to make, let's say $100,000 or $250,000 swings on sizes of portfolios, you apply a 5 cap, all of a sudden you're looking at some substantial value. One of the things that we've seen this year that really has made the difference is being able to give people pricing 3 months early with our instant quote tool, rather than getting that, 3 weeks before closing, you go from a soft quote to a firm quote, and then all of a sudden, there's this magical 30% increase, and you're like, well, how do I make the deal work now? Yeah. And in some case, 30% increase is the best case. A lot of coastal properties are getting over a double at this point. And so I think that's really the benefit is having a fixed rate, which is what we provide. And so it's almost kind of like if you think of like a loan assumption in some way. Now that's tied specific to that loan and to that address. But we have a fixed rate that applies as long as it meets the criteria. It's something that's fixed all the way through the end of the year. And so the ability to have, some stability and the predictability of knowing what that price is, where when you go to the open market, that range of fluctuation right now is what's killing deals, especially people who were under contract before some of the rates spiked. Those are some of the most painful ones. And so learning how to properly underwrite, not only for this year, but for the next probably 18 to 24 months, having the right expense escalators, learning how to underwrite for the future term. A lot of people just kind of plug in a 3% or a 5% expense escalator and run it through till sell. And they're learning that that's actually not what you want to do for every line item. Some expense items do need to be underwritten individually, and insurance is definitely one of those. So what we've put together is essentially the underwriter or the syndicator's dream is the ability to get a very reliable number early in the process. And I think that's really helped a lot of people. I know there's people that are here and also people that are watching as well that has actually saved a couple of deals even. To the extent where if let's say that you're bidding on a deal and if you're able to cut insurance $50,000, right? You apply a 5 cap to that, and all of a sudden that's $1 million difference, right? And so I think the ability to go out and start to bid higher, the ability to go in and nudge from second place to first place, that's huge. Because in this business, second place doesn't make any money. And so, if you're able to kind of edge out over your competitor and figure out, how do I actually take out that larger deal, and you can start to build that portfolio and actually winning the deal in first place, that can make or break a portfolio as well. Because it's not just a deal by deal scenario too. You're looking at the big picture. And so to have some kind of consistency to insurance during a turbulent market can help you grow a portfolio. It's hard to build without a solid foundation. Yeah. And, it's one of the top 3 expenses along with, taxes and management, right? It is a substantial expense that you really got to pay attention upon, And so I think that's the big difference that a lot of our clients have absolutely raved over is the ability to have pricing before you get under contract and it's firm, the ability to know where that bullseye is at. Because if you all of a sudden have a moving target and you're trying to hit a bullseye, and you're counting every expense item to get down to NOI and apply, a cap rate to it. If all of a sudden you have one expense item that jumps $80,000, what do you do, right? And so that's been our biggest, golden ticket that people absolutely love. Yeah.
I'll attest to that.
Yeah. Andrew, how much does $20,000 change like a $10 million loan? Like $20,000 more in expenses, like would that $10 million loan be 9.6?
Yeah, it's probably going to cost you a couple $100,000.
Yeah. So that case in point.
But
right.
on a $50 million mortgage, it's going to cost you over $1 million.
Right.
Oh yeah. Yeah, and a lot of what we do, we're focused at the bare minimum. We say a unit count of 100, but it's really a TIV threshold. And so when you start dealing with the large size deals that we operate in, these aren't just small shifts. These are massive swings. We typically deal with portfolio clients, so it's something we're not usually looking at one deal at a time. It's looking at multiple deals. And so that's when you start having, $100,000 swings in an expense. That really will lead to sometimes over $1 million or multi-million-dollar portfolio savings. And at the end of the day, like he's saying, that affects loan proceeds. It affects a lot of things down the line that you might not see on the surface level. But, if all of a sudden loan proceeds are cut, the deal starts getting tight, and that's where people are starting to see cash flow issues going into 2023 is, you got to really protect every single dollar. And I think insurance is one of those that has the highest variability right now. Of course, interest rates are always, they're fluctuating for the past, 12 to 18 months or so. But I think interest rates are the oddball that most people can't pin down. And, you could submit a deal, let's say it's in Dallas and it's a 1980s deal. And you might say, okay, let's plug and chug 700 a door. And that's been kind of this mythical, pick a number per door. And that's a really, really bad way to approach insurance. Mm-hmm. So I tell people it's kind of like if you were to relate it to acquisitions. You would never buy purely on price per door. You got to look at price per square foot. Because if you're buying, let's say, a 400 efficiency unit, square foot efficiency unit over in Austin versus a 1,500 square foot townhome over in San Antonio, you can't compare them on per door basis. And so it's the same thing with insurance, right? In acquisitions, you would want to look at what's the per square foot in both, so you can kind of measure, price per pound. In insurance, we have what's called rate per hundred. And I don't know how in depth we want to kind of go into some of that, but that's really what in the market right now, understanding insurance, how to calculate it, the formulas behind it, and becoming educated in one of those, top 3 expenses. And that is really what will make or break a deal this year. And I see for the probably next 18 months or so, it's going to continue to have this elevated sense of high insurance. I think there's going to be a cooling off period, but really the question is what caused it, right? So January 1st of this year is what went into effect. All the actuarials and the mathematics behind on the carrier side has come to surface from the 2 major natural disasters that hit Florida. And so, of course, those were last year. One of those is what made the news and everybody talked about. But those 2 combined led to a $60 billion reinsurance shortfall.
Wow.
And so, if you could imagine, let's say you're going into a renewal and you have, let's say, only $80,000 in an escrow account, and you get an invoice for $100,000. Well, what do? Right? You have a $20,000 shortfall. This is what happened to the reinsurance market to the tune of about $60 billion with a B. And some estimates as high as $80 billion in the calculations. But I think agreed upon $60 billion is the comfortable number. So, how does that work? Well, they have to increase their rates in order to capture that loss. It's kind of like if you think on a T12, right? You're looking at rental income, you have expenses and what's your NOI. Same thing on their side as well. They're looking at, premiums collected, expense paid, which would be their claims, and what's their delta. And unfortunately, their delta or NOI at the bottom line was negative $60 billion.
Wow.
So, if I came up here with a deal and I pitched you and I said NOI is negative $60 billion, all of you would probably laugh at me, right? Yeah. If you had a portfolio, right? So that's what they're doing is how do you come back to break even? And I think the positive spin on that is this. The ability to find a group with a fixed rate can help navigate the turbulent waters. Whereas if you go to the open market, there's easily a 40 to 50 point spread above what we have. In a lot of coastal situations, they're over double. And I think that's the really heartbreaking news that we're hearing from a lot of people that are switching to us is, getting the renewals, seeing the premiums increasing. It's painful,
Damn.
Yeah. Yeah. So there's an example I could think of here recently. I won't name names, but it went from 126,000 in premium to over $500,000. That was a coastal property, of course, but when a double is the best case, underwriting is completely out the window. They were probably using a standardized, call it 3% or 5% escalator, and all of a sudden, you go from 126 to I think it was like 514,000 or something like that. You can't possibly underwrite for that. They're pulling cash out. They're doing capital calls. That is really where you have to have an insurance professional on your team that's looking at it as a portfolio level rather than just a transaction by transaction vendor that, hey, I'll sell you the deal and then I'm gone, right? You got your coverage, I'm disappearing for 11 months. And then they show up at a renewal. You really need an insurance partner that views your strategy as a whole and serves as almost a teammate on your team or, the insurance department of your team. And that's really what we provide as. And so we're not we typically don't do kind of smaller ones and we're not looking at below 100 units. We're looking for more of a portfolio. But that's really the value that we add to people is we can serve, especially if you have 20, 30 deals and a lot of the larger clients that we have, there's no way you can juggle that many renewals either, right?
Yeah.
And so the true seasoned professional that only does that, and that's exclusively what we do. We don't do anything outside of multifamily. There's no other type of commercial that we do. We won't even do hotels, student, senior. I mean, a lot of these are extremely similar to traditional
Very
multifamily,
similar.
Yeah.
Let alone doing retail or strip centers or anything like that. And so when you get someone that focuses, 60, 70, 80 hours a week on one thing, they become really good at it. And so that's between me and my business partner, Dan. That's all we do. We don't do anything other than 100-plus unit multifamily. And so when you need, it's like I always make a joke, if I had to have brain surgery, unfortunately, I want the best in the country, right? I don't want the guy that part-time does a little brain surgery, he'll help you with your flu on the side and he'll give you some cold meds too, right? I want the guy that's the absolute best in the country, right? And so, you really got to find someone that's not, having quotas for home, life, and auto, and they just have access to multifamily. And that's unfortunately what a lot of exists in the market.
Yeah. Rock, I was curious from a quote perspective,
Sure.
what are the biggest factors affecting the rate for a property's insurance?
It's an excellent
policy
question.
premium?
Yeah. So what I'd tell you is it really boils down to two variables: the replacement cost, which is spoken in terms of price per square foot, and the rate per hundred, which is what I was mentioning a minute ago. And so the price per square foot is largely going to be dictated by vintage. I'd say 120 is a good loose ballpark without getting into specifics for this year. I've seen that increase from, call it 80 to 90 a couple of years ago. We've pushed that to just over 100 about a year ago. And then I think 120 is a very good, reliable number for an entry point. If you're looking at, let's say, a Class B, Class C deal. Now, when you get into Class A or kind of newer deals, I would say you probably would want to bump that to maybe 140 to 160 range. If you get into mid-rises or high-rises, it'll go up from there. But, so that's the first variable that I would say. The second one would be the insurance rate, or what's called the rate per hundred. And so that cost per square foot is going to be typically dictated by the lender, as well as, the building value, the income value, contents value, all that's kind of dictated by the lender. The rate per hundred is going to be picked by the insurance company. And so that's really understanding how that's calculated. And on the insurance side, having a large Rolodex of people that you can contact. Usually when we go out and shop these, if we're looking at a geo, for example, I'll put this to 40 or 50 different companies. Most people don't have that ability, that wide of an access. They'll have a select group of people they can go to. And so, to kind of answer the question directly, they are inversely related. So you would want to know the cost per square foot and that rate per hundred. As you increase the cost per square foot, your rate per hundred would typically drop. So that's a lot of times what you'll see with Class A properties. When you start pushing that to 150, 160 and up, you'll see that they'll actually have a lower rate. And so you got to learn where's that trade-off, and you'll see two lines that essentially intersect, and learning how to stay below that curve. That's really the kind of the science behind it.
Very good.
Yeah.
And Ford, do you invest yourself in multifamily?
Yes, passively.
Yes.
I bought an 8-plex with some buddies one time, and it was a lot of work. We were managing it ourselves. It was like picking up trash and on the way to work and spraying countertops and stuff. So not doing that anymore. But just passively with clients or people that we trust and know. So,
Yeah. Do you guys? Do you, Rock?
Yes, I do.
Yes.
Yeah. So right now, I just see this all the time through the investors. Right. We did it this year. We did a survey. We get all of our database of investors, say, what is your appetite for 2023? And we ask questions like, how much have you wanted to invest? And it was interesting to see the responses, right? And we see the appetite of some of the folks that some of them are, know the business, understand that, the fundamentals doesn't change, but you just have to position yourself with different strategy. But some people are just like, they're scared. And it's like, multifamily right now is not the way to go. And what would it be, each of you, opinion for that purposes for multifamily?
What I would say is the seasoned buyers that I deal with, they buy in every part of the cycle. But the thing is, they're seasoned, so they know when and how to buy. They understand how to enter the market, because a market that's going up on a cycle versus something that's coming down on a cycle, you have to enter in a much different fashion. And so that's what I would tell you, because I deal with, a lot of my clients, I'd say average probably 15, 20 properties, and some of the largest 50 or 60 locations. And so I heavily watch their approach, what's their strategy, how do they enter, and more importantly, how do you exit, right? And so I would say that I hear people sometimes say that you want to wait to get into the market. I don't think that's ever a good scenario, right? As long as you're educated, you understand the market, you understand your expenses, how to add value, increase, NOI. And at the end of the day, if you have, good guys like these up here to help you across the finish line too, right? That's putting together a team and understanding how that works. I guess that's the other thing I would say is having a solid team. A lot of these people where, if they're just turning and burning and getting different, insurance guys or different debt guys, or, they're back and forth trying to, burn in different agents back and forth. Or if you're just always getting another broker, right? Yeah. The loyalty in the market, that is what helps, from an accountant, from a good attorney, across the board, building a solid team.
That's why we just buy deals from Ford.
Make it easy.
Yeah, make it easy, man. And the finance deals with Andrew after we
Where do I get my insurance quote from? Yep. Everyone here.
It really is a good point, right? I mean, this is the same team. We've done, 3 transactions, one in 2021, one to 2022, and one this year, right?
Yeah.
I mean, is that so? It's the same team. I think it's well said, right? If you have a good team and a good plan, and you're hip with the market, for lack of a better term, you're going to be probably okay.
Yeah.
You should be. That probably comes back to your team. So I think, right now there's an opportunity. It's a different opportunity, right? You're not you're buying stuff at a 5.5 or a 6 cap as opposed to a 4 cap. So that's opportunity, but there's threats that go along with that as well. You just have to understand them and have the right people around you.
I love that approach, man, to be able to, like, Daddy makes fun of you. Can I go to a restaurant? I like to go to the same freaking restaurant and I order the same freaking dish. She's like, don't you want to try something new? And it's like, man, I just like what I like, man. You know what I'm saying?
You're not that old yet.
Huh?
Not that old yet.
I guess I have an old spirit, you know? But to my point, like, be able to trust the people that work together, know what to expect, and know being successful together. Especially we think this is it's a big industry, but it's small in a certain sense, right? And by having a good team on your side, definitely a long way. But back to my question, what do you think about it?
Sure, yeah. So I'll give a perspective strictly from the standpoint of financing. Ford can attest to this. One of the number one factors that plays into a buyer's evaluation of a property is what kind of financing they can get. And the type of financing that you can get from a leverage standpoint is very much driven by where interest rates are. So I think over the last 3 years, we've seen very clearly that circa 2020, rates were at 2%, people were paying very, very high prices. Circa 2023, those prices have all come down significantly. So to me, if I'm evaluating a property and I see a deal that I can get at a discount to the sales comps and a discount to what it was offered at in the last 18 months, and I know that I'm making the deal work at a 5% interest rate, and I'm of the opinion and operating under the assumption that rates are going to come down, well, then you know that someone's going to be able to pay more for your property because they're going to be able to get more in the order of financing when rates are lower. So to me, it feels like a really good time to buy if you place flex prepay on your financing and you get a discount to the basis.
Yeah.
I'd like to turn the question back on you.
Oh.
What do you think?
Well, like I said, based on I just, talking to a few of our own investors, like, what is your appetite? What is going on in the market? And I do believe the typical retail investor, let's say, has a job and a very high incomer, he all believes on stocks. There's the first option, and then they start getting their feet wet on a multifamily, and getting that. The returns is just solid, right? It's the stress. Some people really like that rush of going up and down, and some people do believe in diversifications. But I do believe that I think people ask me, hey, we're going to try something else out of the multifamily. I don't think I do. Storages and stuff, nothing wrong with does it. It's just like, I want to, like you said earlier, I want to focus in one thing, make sure this business is operating, because, we are very hands-on in our properties. And above all of this, I think it closes the cycle when we do approach with the community first, just like Fannie on the loan, like we're very community-based on our properties. Like, we take care of the tenants, we try to give them a better living, try to put good people to work on our properties. And that, for the past 3 years, is just we getting phenomenal results by having that approach, taking care of the community take care of the property take care of our investors, right? And that, I was speaking to somebody's podcast the other day. It's like, what is your secret? Just, right now, is there any advice? What would be your secrets? It was like, I think that's it, right? Just taking care of that community, man, and just everything falls on and along, following along with good teams, good people. Surround yourself with like-minded people. And investment on real estate is just like when you find good people like that, they have that mindset, I think you're going to be successful as an investor, investing with such folks. And the piece of advice I would give for our investors is, like, get yourself educated a little bit. We put even a course for our investors. A lot of, when we started this business, friends and family, and I have people have no idea. They're just like, I trust you, and I'm like, here you go. But we like to educate our investors. That's why we do those events. It's like, man, listen from not just from us, right? People in the business, So this course is just about you be a sophisticated investor. So if you are getting approached to a deal, you'll be able to at least a few key points. You don't need to understand everything. Like, for me, I need probably a college 4 year of a college education for just to understand a lot of the stuff that he knows. But to my point, it's like a few key points for you to understand, right? Understand the basics, the fundamentals, and I think that's the recipe for a successful, being a passive, successful investor in this industry.
Yeah. And I just want to add 2 points. I mean, the best underwriting aside, it's how you operate the property and the intangibles. So, for instance, building that community, that's what makes people renew and want to stay and refer. So there's some things that you can't even put numbers on. It's that spirit that you build at that community and grow. So when we talk about Fannie and Freddie and having affordability in different programs, like, I mean, it just warms my heart because Neander and I also grew up in communities very much like the ones that we own today. And then the second thing I want to emphasize is that, you know, multifamily is a team sport. So Neander and I aren't experts at what we do, but we have a team of experts that, you know the best deals in DFW, the best financing, the best insurance. So it all is a team sport, and you always want to make sure that if you're going to invest, you invest with a team that you know, like, and trust.
Sweet.
To add on to, I know he touched on stocks for just a minute ago. If you're ever on the fence of looking at stocks versus real estate, I'll give you the one golden nugget of why you should go with real estate, and it's very simple. There is not a financial backstop that's the same in real estate as there would be, if you were investing in stocks. And in real estate, you have the financial backstop of insurance. There's a apartment across the street over here. If that building burned to the slab, all the way to the slab, right? They're going to build that back with new construction. It'll look just as good and probably better than it did before. That's the financial backstop. You don't really have that with stocks, right? Yeah, you could put shorts or puts. You can do different things and play spreads, right? But at the end of the day, you have one direction that you're betting on. And with real estate, you have a financial backstop that if the worst, or if that nightmare did happen, whether it's a hurricane or a tornado or a fire were to hit it, right, you are essentially financially protected. You have a backstop that will catch you as a security in the event of something going wrong, right? And for me, that's why I put a pretty heavy amount into real estate, is because I know that at the end of the day, if I'm going to say if the stuff hits the fan, you're covered.
Here.
Yeah. Trust me, if you get on a call with me, you're going to hear a lot more than just that. But, I think that's something that peace of mind at the end of the day, when you're putting in the kind of money that it takes to get into syndication deals, you need to be able to sleep at night. And I would tell you, there's all kinds of other benefits and tax reasons and all kinds of other things of why you should invest. But at the end of the day, you got to look at also not just the beautiful, rosy stuff, but what happens when things go wrong, right? And knowing that you have that kind of coverage, that is something that really helps people sleep at night. That's different than stocks.
Yes. It's interesting. One time a fire happened in one of our properties. Luckily, it was just one unit, and nobody got hurt. Nothing happened majorly. But everybody that I talked to, friends and family, oh my God, is everything okay? Like, they already do automatic, like, you lost your money, lost everything, right? And I was like, well, we're not even going to call insurance for this one because, we have our vertically integrated our construction companies, less than deductible, and let's just do it. It's not a big deal, right? But in fact, that if having a big deal, of course, we will love to not everybody get hurt, nothing major just happened. But if it does happen to burn to the ground, obviously that's why we have Rock. We'll be calling you. Mm-hmm. But anyways, I appreciate you guys coming by today. And we're going to open a little bit for Q&A. But before we do it, and if you are new to our platforms and to here, if you are interested to start investing in multifamily, go ahead and tap it in the chat. Just say I, and one of our teams is going to go and contact with you. You can book a call with us. We have me, Dala, Italo here to answer any questions during the week and just kind of plan out. There is our course too online if you take advantage of that. If you want to, get a little bit more educated on apartment, we cover a lot of it's 5 or 6 modules and 50 plus videos about every single thing that, how to be a passive investor about this. And let's go get some questions. So we're going to pass the microphone out. Ito has the microphone there. Just raise your hand online too. If you guys have questions, you can tap it on the chat, or you can we can hear you guys. So just unmute yourself and you can ask your question there.
Absolutely.
From online.
Are we starting here or are we starting live?
We start here first.
Anybody got any questions?
Question for...
I got you.
Yeah.
I got Sergio right here.
How's everybody doing tonight? By the
Let's
way,
go.
amazing. Having a lot of fun tonight. So
Let's go.
Thank you guys for hosting this. This question's for Mr. Broker. There's a lot of masterminds going around, a lot of new, syndicators in the area. Any advice that you would give these newer individuals that are getting into multifamily investments on how to talk to and how not to talk to a broker, because you can probably smell one from a mile away and you can kind of start thinking, you know what, we're not going to cross the finish line with this guy. Any advice for anybody that's kind of new who's going to listen to this podcast?
Sure, that was a great question. Thank you.
Read the OM.
Read the OM first. That always helps. But to kind of answer the first part of it, I think when you align yourselves with groups like Multifamily Empire or some of these other syndication groups, that already lends a ton of credibility to when I get a phone call. I'm friends with Neander and Delia. Cool. Do you want to go to lunch or something? Right? Like I would probably invite you out. Right? These are our friends. We trust them. So I think that's a good place to start as well. And then when you're contacting us, I think sometimes it's easier to kind of, instead of going for the top, maybe start some of the other guys on the team and get a rapport there. Another thing is send an email, like a well thought out, well written email with questions and stuff like that, and then read the OM beforehand. And if you call and we have a good 15-minute conversation about a deal, and you know what you're talking about, I'm probably never going to think twice about whether you started. Whether you read Commercial Real Estate for Dummies yesterday. Or years ago, right? So, the joke, I read that on the way to my first interview,
It's awesome.
I think hopefully that answers your question.
He was too nice. Okay, I'm gonna say two things. I'll say read the freaking OM, and that's number one, and don't invite them to lunch if you don't know them. That's right. I was like, yeah, sure.
If you're paying.
No, okay, all right, yeah, that's a good point.
Absolutely.
Great
Anybody
question.
else?
Thank you.
Or you could take him to Costco.
Yeah.
All right. I have some questions here from the online folks.
Come on, guys, don't be intimidated.
I
Look,
know.
this guy has tons of knowledge here. Come
I
on.
know,
Everybody was
Sean has a
talking.
question.
Sean,
Okay, so
There
let's
you go.
bring
go.
it on.
I'm not even sure I need the mic, but I guess that way.
The online
get
people
recording.
can hear you.
Are we on?
Yeah.
Oh,
we
okay.
are.
So yeah, it's like I don't hear myself here, but no. Again, thank you guys for hosting. Thank you guys for showing
you.
up and sharing your knowledge. Really do appreciate all that, and you guys taking time out of your evening to do that. My question at Rock is, what kind of effect do you see on properties where we've had to file a claim, and how do you see that affecting future costs?
I would say it's a very good question for this market, and it's a different answer than I would have given you last year. So the sensitivity to claims has increased, and I would say as rates increase, those are kind of in tandem. So carriers, as claims begin to turn in, you're going to see an increase of rate normally. The percentage of increase is what's going up. And I think what they're looking at is a couple of things. What caused it? What have they done to mitigate it from happening again? Is it tenant caused? Is it something characteristic of the property? Is it going to repeat itself? Has there been CapEx dollars to prevent it from reoccurring? And a lot of times, if it's something that's tenant caused, if they've been evicted, that kind of helps. But let's say that it's something, let's say it was a fire and it was caused by stab blocks, and there's still, 200 of them in each, one in each unit kind of thing, right? That's going to be a major underwriting factor that's taken into play. And a lot of them are cracking down on those risk factors that they kind of previously would turn the other way almost, and now they're really strictly enforcing it. So claims, that would be one. So magnitude of the claim, frequency would be the other. And so those kind of going in both together, that's really what's causing some of the rate increases as well. Yeah.
Yeah, I've seen lenders, increase their scrutiny on stab locks as well as the pigtail wiring mitigation and some of the other issues you have to deal with in the older buildings.
Right. Yeah, I think both stab locks and, to a lesser extent, aluminum, even if it's remediated, stab locks are going to be very quickly almost uninsurable in the next, what I would say, probably the next 2 to 4 years.
Yeah.
The number of companies that used to be willing to write it, or at least didn't exclude it, has dwindled. I'd say probably 3 or 4 years ago, there was still about a half dozen geo brokers that I could go to that would still do it. It's dwindled last year, I'd say 2 or 3, and this year it's probably 1 or 2. And I think with that trend continuing, it's going to get to a point that you either have to replace it or it's going to be almost uninsurable. And that has nothing to do with frequency of claims, right? But I think that is one of the root sources that can cause claims. And that's heavily why they want to get those replaced. Is any type of risk factor, they want to address that before something goes wrong. And unfortunately, they were just known to cause fires. And they were predominantly installed, call it the 60s, 70s, and I think early part of the 80s. So if you're looking at a 90s deal and newer, you pretty much don't have to worry about that.
Yeah, so just a little backstory about the Stablocks and Federal Pacific. It was one of the 2 electrical panels, the breaker box, you'll have it in your house. So every unit, they have their own, electrical panel in their breaker box, and those was big recalls, catching on fire. So now insurance and lending, there'll be like, you have to replace those. And so we actually had a property that has a few of those, and we are in the process of replacing all of them. But yeah, so that's what they're talking about, just a little bit of contest for some people.
And just to piggyback off Sean's question, but I don't want to talk any more about Stablocks because I come across them too much. But just in general, what are some things, without spending a ton of money on a property, but, people own 60s, 70s, 80s deals. What can they do, to kind of keep these renewals from, other than calling you, but which they should do, but, keep these renewals from jumping up?
Honestly, the way that I would look at it, because I don't want to tell somebody just for a singular renewal. What I look at is the life of the deal. And so I think what's most important, in my opinion, would be, if you're going to have a 7-year hold, you don't want to just have one good renewal, right? So you really do need to have, whether it's me or another group or whoever it might be, what I tell people is you need to interview the agent and put all of your trust into that person and know that they're shopping the market. And I think at the end of the day, when you have someone that's a multi-year strategy rather than just looking at, hey, I saved them a bunch of money this year and then, oh, well, I'm sorry about the next year, right? Because it doesn't take much, but if you're on the 3rd or 4th year and all of a sudden you have enough to, wipe out cash flow, I think that's probably one of the best ways that I would approach it, would be look at it from the life of the hold, not just from a singular approach. Now, what things could you physically do? With CapEx, there's a lot of times that, unfortunately, the insurance requirements don't drive rental revenue. So I think that's kind of the ebb and flow or the trade-off almost. Anything to do with roofs or, breaker boxes, unfortunately, nobody was like, oh man, they just replaced all those shingles. I'm willing to pay another $100 a month for that. It just doesn't exist like that.
If you put it in style, you could put some
Hey,
color in there.
maybe if you put some tile or clay or something up there that looks real, Californian style maybe. But no, I think at the end of the day, the ability to take care of your tenants, that's really what drives the rental side of things, and that's going to help cash flow. And so I think, and that's a lot of the points that they've touched on, is the ability to create a culture behind it, the ability to take care of your tenants, to create that sense of community. That's what's going to lead to the rental side. On the insurance side, it's more of maintaining insurability for the long term at a very reasonable price in the market. So I don't know that directly answers your question, but I think that's how I would approach it, is rather than looking at one snapshot of time, is to look at what's the big picture, and that's really where you need someone on your team rather than just a vendor that's there to sell you a policy and then they're gone. And having someone that's not only looking at a 7-year approach, but if you have, let's say, 10 deals, right, you really need a strategy across the board. And that's, again, going back to the team, right, whether it's on the broker side or debt side or just kind of across the board, good legal team. That's really what makes or breaks big groups for the long term, is what I would say.
Yeah, I love it.
Awesome. I have a question here. Anderson, Neander, Delia, thanks so much for hosting us. What you guys are doing, your staff is phenomenal. The setup here is great. The caliber of the panelists is just awesome. Thanks so much. Huge service for investors, right, and community. So I have a question for Andrew. In this market, have you seen any dramatic change on the requirements, right, that agency loans are taking on, new buyers? What any change there? Any tips for people approaching, right, in this time of the
Sure. I mean, in terms of guarantor requirements, key principal requirements, they've stayed largely the same. 100% of the loan amount net worth, 10% of the loan amount liquid. is a primary financial wherewithal requirement for a guarantor. I think knowing that rates are a little bit higher, we've actually gotten a little bit more aggressive on certain credit underwriting standards. So I mean, from an overall sizing standpoint, over the last 7 years, it's really been a 1.25x amortizing DSCR that's the primary constrainer for your loan proceeds, debt service coverage constraint. Max LTV has stayed around 80%. With some bridge lenders, they'll go to 85. I think the overall credit parameters have stayed very similar to what they have been over the last 7 years. I think if you're a new multifamily owner coming into the business, you've never done a loan, a multifamily loan or anything like that, I think the most important thing is to make sure that you have good, strong, reputable third-party management coming in. Ideally as a lender, I like to see first-time borrowers have proximity to the property that they're looking to acquire. It makes us feel a lot more comfortable when they're able to drive to the asset and make sure they can take care of an issue. If I have someone who's in California trying to buy a deal in Tyler, Texas, I'm not going to feel as comfortable as someone who lives in Grand Prairie, who's able to drive to the asset if there's some kind of an issue. So I think we're very much open to first-time multifamily operators and owners from a GP standpoint. You just have to make sure that you have a good third-party manager coming in to help you run the asset, and that you have proximity to your investment. And skin in the game is important as well. What we see in the syndication world, a lot of folks trying to put in as minimal money as possible, and we like to see, typically, most lenders will like to see a 5% GP investment. And I think that's very important, because if you're coming in, you're putting in 1%, and you're charging an acquisitions fee, then really you're actually not putting any money in the deal, and that doesn't really make us feel comfortable from a lending standpoint, because when we're going through the underwriting and due diligence process, we're learning you, we're understanding who you are, and we want to make sure that you are able to run this asset within the underwriting parameters that we're sizing the deal at. So I think those are probably the three most important things: third-party management, equity in the deal, skin in the game, and proximity to your investment.
Go ahead. No, it's just a quick comment. Every capital raise that we ever done, and this would, be our sixth capital raise, a lot of people ask you how much of your own money you invested on. Because, you put it in perspective, they're going to invest with you, right? It's like how much skin in the game, even from the lender and from the investor perspective, in our old-fashioned way that we do the syndication model, and we have to have skin in the game. It's important. Go ahead, Anderson.
No, that's awesome. Thank you. I have another question for Ford. You guys, your team have done probably hundreds of transactions last year, so you probably have a very good pulse of the market nowadays. Do you feel there is a sense of a lot of people parking capital, waiting to invest, or waiting for that great opportunity, that deal, they're opportunistic, or do you have that sense? I'm asking that because talking with investors, I'm seeing regular investors, people still, right, W-2, high income, they're kind of hesitating, right? And with all this volatility, they're kind of waiting to see what's going to happen, right? Do you have that sense that there's a lot of capital parking lot just waiting to be deployed?
I guess I would say yes and no. I know that's a horrible answer, but I think you look at it where y'all's syndication retail investors, it depends, but if they had their money in a 401k and the stock market just dropped 25-30%, they drop their 401k probably 20 to 25%, something like that. So no, they don't have as much capital, but also we know that they may not have had that in a 401k and it was just in a bank account or parked somewhere in a fund, a bond, but they're nervous. So it's still not technically out there, right? But at the same time, we went to NMHC this year. I think Al and I met with, 60 some odd meetings between the two of us over a day and a half period, and every single person was like, we've got equity, we've got backing, or this is what we want to do, and at the same time, we haven't had shortfall issues this year with people that are offering our deals. We haven't had issues with raises, and so I think for the most part, it still is out there for the right deals, but I still think people are a little hesitant.
Yeah.
As well.
Well, just very basic, but let's say that you're since last year, when interest rates start going high and all that stuff, and that your money's sitting on the bank, right? The value of that is just keeping higher and higher, lower and lower the value of the money, but the cost of everything else is going up. So it's just, I mean, call it inflation, man. At first, to your point, stocks or crypto, which we had some cash in the crypto, and it's entertaining to see, because I have low cash in there, but like it's just crazy how much, like an hour, second hour, is just like it drops, it keeps going up. I don't know, that is just giving me a lot of anxiety, right? But what I could be encouraging a lot of people from retail investors, man, is that look, come to the property with me. Come to one of my properties. I take one of my properties. Once they walk in the property, dude, it changes the game completely, because that became real. Imagine if you have a stocks at Tesla, right? And imagine if Elon Musk would invite you to come and have a tour, right? You just have a different look of everything. And, that's what his fear is. Like his multifamily, everybody talks about now. It's a very hot topic, multifamily. But a lot of people still, and I still have investors that never been to the property. They invested like $1 million, never been to the property once. One guy put $1 million, never been to the property. You know what I mean? So imagine that, right? But, the people that are on the fence now, obviously the numbers need to make sense. You need to do your due diligence. Need to vet who is the person, the team that is running that deal. But just to the fact that when you come take a tour on the property with me, it just changes the game.
Good deal. All right, I have one question here. I actually have two questions from the online folks. First one is from Vin P. Thank you so much for your question. Vin P says, what are some tips or strategies for identifying and acquiring off-market multifamily deals in DFW? And following up on that, what will be key metrics or indicators that investors should analyze when evaluating those properties? He also said, thanks in advance, very informative webinar and super knowledgeable folks.
All right. Well, yeah, Al and I don't tend to do a ton of off-market transactions. So, we do some. We did a couple last year, right, opportunistically, or clients that we trust. But we don't do a ton. And frankly, from what I've seen this year, and y'all are the ones really more looking at deals than I are. We're doing BOVs, but we're not getting asked from other brokers. But I feel like the stuff I've seen or heard off-market this year was kind of the 2022 pricing. Trying to, get it back out quietly in early 23. Of course, that's not a one-size-fits-all answer. What I've seen, that seems to ring pretty true. So I think for off-market, opportunities, though, in general, get to know the brokers, right? Yeah. Question number one: how do you get to know the brokers? If they trust you and they have an off-market deal, they're calling 3 people. You want to be one of them, right?
Right.
So, and that comes back to track record and doing what you say you're going to do, reading the OM beforehand, things like that.
Good, yeah. And I think it's important when the broker understands your business model too, right? Because obviously you have some kind of strategy or business model. Like, for example, like we love the value adds that we can come in and do renovations. We are vertically integrated in our construction company, so we have different leverage than other people that don't. That's why we like to buy, some of those assets that we can add the value, man. You know what I'm saying? Right. And soon we are in contact now with bringing our stuff to right. We actually have a few items that we sell, but we're actually talking to China. This floor right now, where you're seeing it stemming on, this is one of our floorings that we're bringing those at a lot lower cost. That will be able to, to make those deals done, because better to attend for those properties, right? So that is our appetite, that's our motto, So, but that might be different from a lot of people. But I think my point is, if the broker understands this model, it's like, he might be, hey, I got an off-market deal that might work for you. We need to pay this much. This is it. No bullshit. Just let's go. So would you agree to that?
Yeah, I would agree to that. I think every time our team lists a deal, Al, Dylan, and I kind of will sit there and we all think of 10 or 12 people that we know off the top of our head that are a good fit for that property. And there you go. That's 30 buyers, right? Just off the top, from all 3 of us thinking about it. So every single deal that's a couple days beforehand, the night beforehand, I'm like, all right, who's a good fit for the? I need to make sure I call so-and-so tomorrow. So that's exactly true.
Yeah.
Exactly true. All right. Well, I think we're going to wrap it up. But, Al, thank you so much for your time. Really appreciate it.
Yeah.
Thank you.
Do we have time for one more?
Last one. Let's go.
All right. So this one is from the folks watching us on LinkedIn. This one is from Anselmo Torres. What can property management companies do to help brokers get top dollar for properties?
Get the highest rents.
Yes, I was gonna say.
But no, and Selma's a great friend, and I appreciate the question, man. But yeah, I mean, they're one of the companies that we would go to and ask for a pro forma, right? If we're going to be selling a property, and so obviously that helps when we can be aligned with the property management company and make sure we know what they know what we know, and that way the buyers know everything, right? And so I think that's important because at the end of the day, you're going to get the best value possible by everyone knowing what they're walking into, as opposed to surprising someone later. That's just not going to work out. But the other thing, I think there's some properties you go to and they've got trash and wood rot and stuff like that, and sometimes it's an operator thing, sometimes it's a management company thing. But other management companies, if everything clean, smile when you open the door, that shows to us as investing in this, but it also shows the tenants. They're the first people who see that, and they're the most important people at the end of the day who see that. So I think that's really what it goes back to.
Yeah, and I think people, when they start on the process of selling, some people tend to take their foot off the gas, which that might screw it up, on the very end towards like a loan and all that stuff, right? Because occupancy might drop and some of that stuff there, and like when the lender is looking at the fine print or the fine, that so the flag. So definitely.
I'm really happy you said that. It's hugely important right now for people that are selling their property. I mean, think if you have one month where you don't pay attention, your manager, she's like, hey, I'm going to be out of here in 60 days anyways. Yeah. Occupancy goes from 96 to 92, and your loan proceeds just went down by 4 or 5% as well, and you
now
call
your
extra
numbers don't work
investors,
anymore.
and something's really wrong, and everyone's mad.
Yeah.
So it's extremely important to do
We'll
that.
find a way to make it work.
And that's not, But I think too that goes back to the owners as well. It's not just the management company's job.
Yeah, absolutely, absolutely. I even heard about some bonus structures for the managers too, like just because they might be switching, relocated, and it's like, hey, let's stick around. I'll take your foot off the gas and let's go.
Yeah, exactly. And I think we all know salaries and stuff like that on the T12, right? And think about what $10,000-$20,000 bonuses. Like, hey, if you can maintain this $100,000 income or go from 100 to 105 while we're under contract, they get more loan proceeds and everyone's sleeping better at night. Yep. And that's worth a lot of money, for the owner as well. So, and probably the buyer. Maybe we should start getting buyer management coming in. Bonuses, right? But it's hugely important right now.
Yeah. So Ford, how people get in touch on your firm and out and yourself?
Yeah, I think best thing to do is go to www.silvamultifamily.com. I can rattle off phone numbers if you want. That's probably not very helpful.
No. But we put your
provide the
information
links
on
for
there.
sure.
We'll put a link if you forgot to put in information, emails and stuff.
Perfect.
What about you, Rock?
Yeah, so the best way, other than just contacting me directly, the most valuable thing that you can get from us is just going to that instant quote tool. It takes about 2 minutes to fill it out, and you get back very accurate numbers in 60 seconds. That link is quote.strategicinsurer.com. It's with an ER at the end of insurer. Or you can just go to the website, www.strategicinsurer.com. And you plug in a couple pieces of info. It'll pull some data on the back end along with what you've put in. It'll send out a text and an email with a PDF. Lender requirements, premiums, deductibles, the full breakdown. Make sure it's agency compliant, Fannie Freddie, as well as bridge debt compliant. And I think that's probably the best way is, that's what's valuable, as a potential buyer or a syndicator is, getting on there and using that quote tool, getting familiar with it and how it works.
Yeah, you can reach me by going to bwe.com, and you'll find my contact info along with my partner's contact info. Shoot us an email. Just send us a T12, a rent roll, some info about your refi or your acquisition. We're happy to help. We'll get back to you in about 48 hours, I'd say. Give me a call anytime.
You're usually quicker than that.
For you.
And one thing I have to say about these guys, man, they're super sharp. Like, your team and you as well, man, you guys are like on fire, man. Like, super fast response, super professional. So we're very honored to, you guys actually inspire us.
Yeah, thank you for being on our team.
Yeah.
Thank you. Thank you for having us.
Thank you.
And you guys, man, thank all of you for coming out tonight. Thank you the tech team, the production team, the whole team, man, is just great. And
Everybody.
people just like, I feel emotional and come to that because we know we work very hard and to put a good event for you guys' education. And then, of course, all of you. Shout out to my brother-in-law just flew in. What's up? And guys, network. There's a few drinks. There's still beer, cold ice beer, and there's some. Let's do some networking, exchange some business cards, and talk a few more a little bit. And let's go, man. I appreciate all of you. Thank you guys online for coming in and all the platforms that we're streaming on right now. I know that we have LinkedIn and Facebook and YouTube, all that stuff. You know, appreciate you guys sticking around. But next time, come here in person. Come see our studio. And I appreciate all of you. Thank you. Have a great night.
Thank you.
And remember, if you want to find out what's going on, what's coming next, make sure you follow us on social media. That's very important. That's how you're going to find out what's happening, what's going on, what the next panelists are going to be. Everything, it's always on our social media. So that's the best way for you to find out what's going on in the multifamily empire world.
Check this out, Italo. So here we go. Show the camera over here, okay? So this is our coffee cove where we do the real grind. And this is actually, we just started this Instagram account. But if you actually like our Instagram account, this numbers go up live. So, you know what I mean? There's a little, right now, because we promote it a little bit. So we call it the Real Grind Show.
Follow right now.
Go on
Let's
Instagram,
go, guys.
The
Let's
Real
see
Grind
there.
Show.
I appreciate you guys. Thank you so much.
Thank you so much.
Yeah, now put the lounge music. Yeah.
Thank you so much. No, it was a pleasure having you guys. And I,